Okay, we're going to talk about the DeepTech outlook here. Marty did a bait and switch on me. I was supposed to do a real estate panel, which I've done in the past. Now Marty decided I'm an expert on AI and things like that, which I'm definitely not. So fortunately, we have great panelists here today that are going to talk us through some of the opportunities and challenges in the tech space and what's known as deep tech. I frankly had not heard the term deep tech before. Is everybody familiar with that? People not familiar? Yeah, a lot of yeses. Well, obviously you were. Okay, so then I won't go through definitional thing. I'm going to let our panelists introduce ourselves and we'll get right into it. Andy, why don't you go first?
Hi, Andy Fish. This is my 40th year as a professional investor. I spent 20 years investing for family offices, ran a hedge fund, 3 venture funds, did my first venture deal in 1994. She said we're not allowed to date ourselves. She didn't have to. Anyway, and it was in technology. And I was investing in I had to write my own trading software because you had to write everything back then. That led me to investing in technology, investing in semiconductors, including the stuff that's lithography that's used to make NVIDIA chips, which then led to everything that still leads all the way to this day. So deep tech, nice new word for something that's been around a long time, actually. Neural networks are not new. The ability to get the data and use them is relatively new. The ideas, the technology has been developed a long time ago. So
and before we move on to Lisa, you're an investor now. You have a hedge fund.
I've always been so. I spent 20 years, I said, running venture funds and hedge funds for family offices. I spent 15 years building and running State Street's global fund of hedge funds, which was a third systematic, and the last 8 years back with family offices doing private investments.
Okay, that's what you're doing now. Okay, great. That's what I was asking.
I was really worried because he told me earlier that he was only 40, and I thought, oh no, I'm going to be the oldest person on the panel. Did you know that you wrote that? You're like, I'm 40 years old. I was like, oh. So I'm Lisa Chai, general partner at IvyFON Ventures. We are an early stage venture fund focused on the field of robotics and AI. We are industry agnostic, but we do prefer industries that are going through the most labor challenges like manufacturing, logistics, agriculture, and healthcare. My background, I'm a computer programmer turned investor. I have 20 years plus experience in markets as well as private. Our fund spun out of Robo Global, which is one of the first robotic and AI focused strategies. We started investing in privates many years ago, but it wasn't available to the public until recently. So thank you for having me here. My areas of expertise in the kind of companies we invest in are in the computer vision technologies. Also looking at robotic solutions, especially in the industrial setting like warehouse logistics. We are currently looking at several humanoid companies. We don't have an investment yet. We are looking for certain milestones and metrics, and we are a little bit difficult to police because we have 6 robotic scientists on the team who are very, very selective in what type of companies to be selected into the portfolio.
And you're investing in early stage companies primarily?
Yes. C to Series B is sort of our sweet spot. And some people say that's a little bit of a wider range. When you do invest in robotics and AI, emerging companies, these stages are a little bit blurry. Most of these companies are longer term investments. It does take a lot of capital. So we try not to be so selective in that. We are looking for, because of our public equity sort of backgrounds, we are looking for a product that's already been developed, some type of revenue or customer traction. So we're not a first check investor. But we do have a wide range of companies that we do look at within those range.
Okay, and we have remotely Katya Fisher is with us. And Katya, why don't you tell us a little bit about yourself? I understand you're a lawyer that uses AI as part of the legal expertise that you do.
That's right. Thank you so much for having me. Hi, everyone. You can hear me well? Everything's good?
Oh,
Okay.
yeah.
Fantastic. So yes, so my name is Katya Fisher. I am the Chief Legal Officer and Vice Chairman of Constructor Group. We are a holding company that oversees different businesses in deep tech, science, and education. We have a venture fund, Constructor Capital, which invests in AI, quantum computing, cybersecurity. We have a software company called Constructor Tech, which is all the back-end platform for science, education, and research. We have a nonprofit arm. We have a university in Germany with about 1,800 students and a full campus in Bremen. This is all sponsored by a family office. It's the Arici family office. I'm also the chief legal officer of that family office. So I previously was in private practice. I was a partner in a large law firm. I was the chief privacy officer of that firm the year that GDPR came into existence. I helped the firm to handle all of its data privacy policies. I helped get ISO certification, and I also represented a lot of tech companies. In the last 6 years that I've been working inside of Constructor Group, I've just had a really really cool job. I mean, I have a legal team that reports to me in Switzerland, Germany, and the United States. I work with pretty much every big firm in the world that you can think of. I work in 10 different countries. I represent a family office, VC, software company, nonprofit, like you name it, I've done it. And because I've been so close to people in the tech world, I started thinking about software myself. And so about a year ago, I started building my own legal technology company called Aracore, which is a spin out from Constructor Group. I was very lucky. My boss became my investor and my partner. And we started building software that automates the due diligence process. So I became very frustrated because I was spending enormous amounts of money on external counsel doing due diligence on deals. And I would look at it and be like, okay, these, 28, 29-year-old associates are charging me hundreds of thousands of dollars to read pieces of paper and just tell me what they say. They're not giving me strategic advice. They're not, going really, really deep or telling me what to do or what I should negotiate. They're giving me red flag reports, right? They're reading corporate governance documents, this sort of thing. I want AI to be able to just get rid of that so that I can work much faster, much more efficiently, much better. So we started building it. I have 13 people in my company now. My co-founder is the former chairman of Wilkie Farr and Gallagher. And my advisors include the recently retired general counsel of Insight Venture Partners and the general counsel of Revlon. We started out really thinking that we were going to be selling and marketing to lawyers and to law firms. What we discovered was, unsurprisingly, lawyers are not really early adopters. They're extremely risk averse. They don't like the idea of technology replacing them after all the years that they spent going through law school and learning how to do what they do. But we did find that when we started talking to iBankers, PE funds, venture funds, the adoption and the usage rate really went up because those people in business were really quite excited about it. Because generally speaking, and I'm sure a lot of you can relate, when you're in those fields, you have to look at the same deal documents. You're looking at the same stuff too. You have to be, as smart as your lawyer, and able to get deals done. And so we started finding that was really where our sweet spot was. And that's it. So I continue to hold these two jobs. My legal job with the Constructor is my testing ground, and Aracore is my fun.
And is the legal software technology, is that complete and fully deployed at this point, or are you still developing?
No, we're complete. So we're right about to go to market. We have a number of products that are completely ready. We've built our own small language model. So we have our own proprietary AI, in addition to working with a lot of large language models that are out there. Obviously, there's always more coming on our roadmap, but we're ready to go.
So I'll ask the panel, what, give us a comment on Anthony?
Yeah, I wanted to start with 3 premise before we, because we could talk about anything forever in this conversation.
True.
Right? So 3 premise. First of all, AI makes mistakes. Okay? So it is not physics, it is not science, it is not an algorithm that will do a mathematical calculation. It'll never make a math mistake. It makes mistakes. Let's just leave that as a premise for the moment. AI is not just language, whether it's large language models, small language models. It is also applied to scientific data. More than a decade ago, IBM took Watson and trained it to look at mammograms. It was 77% accurate. Well, you'd say, well, that's not great. Well, it's more accurate than radiologists are. So, but not much. My point is it was measurable. It's been done huge gains in pharmaceutical industry. Now, it makes mistakes again. Let me give you the one example, and I'll leave this for everything else. Imagine your air traffic controllers in AI. How many planes have to crash before it trains itself to not make planes crash? Well, we're not going to do that, okay? What we should do is have an AI overlaying air traffic control and warning air traffic controllers of things that they should look at. So that's the difference between a tool and a solution. And I want to start the conversation with that. And the last part, because Marty put it in the thing, is the venture capital world I've been in for way too long. Venture capitals don't believe it, but there are cycles. There are cycles in every investment realm. Venture capital is not immune. We are in the late stages of a venture capital cycle. There are a lot of companies all thought they would go IPO, they didn't. And so when we're talking about investing, especially in early stage, we should be thinking about paths of growth and funding that don't necessarily include venture capital. So a semiconductor company we invested in, strategic investors came in, and that took the company where it needed to go. The last guy was talking about doing his last round ever. He's not even going into the venture, right? So that's something also to keep in mind, that everything we talk about should be not based on nor on the context of what's going on in venture capital. That would be my intro, and I won't talk about myself.
Okay, do you see the, so you see the IPO market is still being challenged if you look out to 2025?
As somebody that's been half and half careers in private and publics, venture capitalists make the mistake of thinking the IPO market has something to do with venture capital. It doesn't. It has to do with public markets and public market investors' proclivities. So one of the things that's actually gone public, ironically, is a bunch of biotech companies. But biotech in the VC world is completely in the doldrums. Mark, comment?
I just wanted to make one comment on your venture capital statement. You have these tentpole companies, and they dominate all these new venture categories, and as a result, all the new companies that come out get acquired rather than going IPO, right? You look at Google, Facebook, Amazon, Apple. Each one of them has made roughly 20 to 30 acquisitions in. They've made 300 acquisitions over the last 20 years.
But of the 1,000 companies that are mature VC-backed companies, fintech is the heaviest weight, so they are getting acquired. And the ones that are being acquired for that are minority, and AI-driven companies are real minority. Not a fault. It's a factor.
Where are the fallacies of AI?
So
What are the faults of AI?
yeah, you guys, he's asking about what are the faults of AI, and you said that's a problem. Well, all problems have solutions, right? So the first thing is, we've all heard the term garbage in, garbage out. AI is only as good as the data it can look at. You have no data, you have no AI. That's why when I wrote a neural network 25 years ago, it was a toy. Couldn't do anything with it. There was nothing to do with it. So your data matters as much as your AI. And now what happened was Microsoft gave OpenAI $10 billion for NVIDIA chips, and they went And basically ChatGPT just looked at the whole internet. That was just money, the data's there. Now, for you and your company, you have to look at both. And can you get the right data? So if you have bad data, your AI is not going to solve very many problems, okay? Now, on your second point of it being fallible, there's control going in and there's control coming out. So with a lawyer, she can address this, but I would say that it's a tremendous productivity thing. And lawyers, I could probably pass that part of the bar exam because I've read so many docs. But on the other end, you're going to save a lot of time, but you still need a human being to then take that work and do something useful with it. And that's the answer to your fallibility question. Or if it's data, you measure the error rate like you would with anything. You
Now-
measure the error rate.
Now, does your answer matter whether you're talking about generative AI or just regular AI?
So there's only two kinds of real AI right now: machine learning and neural networks. They're cousins. Okay, generative AI and intelligent AI and all those things are theories yet to be proven. I am not saying it won't happen. I'm not saying it won't work. I am saying it's not here today.
Okay, Lisa, you agree with that?
Most of what he's saying is true. There are some companies, just to add to it maybe, is there are some companies that's working on referenceable evidence-based data. So in certain type of structure environments, there's a lot of effort right now using good quality data and making sure that AI is getting referenced. So you're going to see a whole new group of companies coming out to make sure, checking other AI to make sure it's correct. And I think that's an exciting area, and it's going to really clean up some of the error rates. And I think it will be interesting to see which companies will really perform. Many companies are saying they have something that's evidence-based, but it's not. So you have to kind of dig deeper. Are they using the internet data, ChatGPT type data, or are they using a real qualitative data from, let's say, academic source? So it's a very different type of data sets.
So what kind of exits are you looking at for your investments? If you think, particularly if you think the IPO market for AI type companies is going to be challenging.
Yeah, I think what he's also saying is the IPO market overall is it hasn't really come back, right? So AI, I don't think AI is isolated in terms of having that lack of IPO options. I think when the IPO market does come back because of many other factors, liquidity issues, when it does come back, I think a lot of the companies will benefit, especially a lot of the AI and tech companies. The pipeline is extremely strong. I don't think they're going to get the kind of valuation they got from their fundraising, but they will come out and that money will be returning back to the venture investors and it'll be recycled. So that liquidity is really needed for us because we are early stages. We're not really waiting for an IPO. Most of our portfolio companies are going to get either acquired or maybe some of the assets will be sold, or we're looking for secondary investors as well. So there's many different options. We structured it differently because same with Andy that I have the public equity experience and I know it takes 15, 20 years sometimes to go public. So I hope to be retired by that. So we have to find out what are the exit opportunities. We often sell our positions to later stage investors and to us as an exit.
Katya, would you like to weigh in on any of this?
I mean, I would say basically, look, going back to this whole idea that, AI makes mistakes and all of that, I absolutely agree. First of all, AI is not clairvoyant, right? So there seems to be this fallacy that I find among people who are not super familiar with the technology, that it's supposed to be some sort of magical, clairvoyant, solution for everything. It's not. Right. And it is only as good as the data that it's fed. What I do think is really important to understand right now is when we take a look at certain AI tools that have now become very sort of, common to consumers, right? If we take a look at like ChatGPT and things like that, what I would think about, right? And what I spend a lot of time thinking about is these tools are all going to improve exponentially and at lightning speed. When I started telling people a year and a half ago, or maybe it was 2 years ago, I started playing with DALL-E. Anybody here ever played with DALL-E 2? Right? Which was the tool that can make the drawings and everything with OpenAI. And when I started playing with DALL-E 2, I understood what was coming next. I was like, this is being creative. It's creating new artworks. This isn't thumbnail pics off of Google. It's going to be able to do this with words and concepts, right? And sure enough, 2 months later, the first version of ChatGPT came out and everything changed for so many people. And so now you have these new versions that are coming out all the time. And every single time a new version comes out, there's always this sort of pushback of like, well, it's not, perfect, and it's making mistakes, and it can't do what I do, and it can't reason, and it can't this, and it can't that. And that's all true. But that doesn't mean that it won't very soon. Right? So the question really becomes one of being prepared for it. I think what people aren't paying not enough attention to is the data privacy and security and issues around it. And where this data is coming from, how these tools are training off of your data, how to protect data, what it means to use enterprise tools, what privacy policies really mean, what it means to trust these third-party cloud providers and the like in an era where you are now able to structure data in seconds. Because previously, if you were using cloud tools and you had your data being shared by, in Microsoft Azure or whatever, it didn't really matter because it was all unstructured data. But the AI can structure it like that. So AI can figure you out. AI can figure out all of your positions, all of your thoughts, start making predictions and doing all kinds of interesting things. That's where I would be thinking, is kind of on that base layer of how do you future-proof yourself and your company and your business for what's coming down the pipeline.
Are there any answers to that at this point?
Yeah, actually, I want to not
Yeah,
answer,
go ahead.
keep going, is that I wasn't trying to be negative. I agree with everything she just said. It's just what's here today and what's in the future are two different things. So and Marty was gonna ask to talk about alpha. So there's two ways to invest in AI. You can invest in existing companies with existing businesses, just as the last presenter's talking about, where AI is going to increase productivity, increase the productivity, increase their business, and they have a plan to do it versus the ones that don't. The other side are, and maybe early stage VCs. By the way, we're co-investors. We don't run a fund anymore. We invest with VCs. We would be a co-investor in a fund or a co-investor in a company. So that's the model we use today. So we see a lot of different things, and we can go into things without having whole teams of people. So we do look at a lot of things. So the other side is you have the existing companies that can be better. Then you have the disruptors. I think people want to focus completely on the disruptors, whereas the gentleman before was taking Marriott, Bonvoy. I mean, we've heard of all these companies, Home Depot, Lowe's, and then enhancing their business. So if I'm a public equity investor, that's where I'm going. I'm building a portfolio of companies that are all going to increase productivity and profitability with AI. If I'm a public investor. If I'm an early stage investor, I have to be with a disruptor because I'm not going to try and disrupt Home Depot. I mean, I just saw it.
And actually, I have a question for Lisa once you're finished on that.
Hello?
Yeah, so I guess my question is talking about these incremental improvements. Is there any such thing as a warehouse these days that they're not building for robots, right? Like putting wheels on robots. That's like the incremental improvement that Katya was saying. That, everybody says a new version comes out and somebody has some kind of a grief about it, but these robots that come out at work, I don't know, do they have data on how more efficient these robots are than the humans they replaced, or do they keep that kind of data? Or
They do. The wheels and robots were created because it's a replacement for, let's say, humanoid robots that would have 2 legs, and it's much more complicated to build a humanoid robot for the warehouse that's not going to tumble over a human worker. It's not as fast. There's a lot of components that go into it. So if you want to bring the cost down and safer, you just put a wheel on it. Depending on the use cases and the warehouses, right now, the rates of productivity is definitely lower than a human. But where it's really adding value is the warehouses and factories where they actually have a labor shortage. They don't have a human. So you have few workers doing double shifts and they're really getting frustrated, they're leaving, so their churn is high. In that case, you do have to put a robotic solution to help in that place. So you're not replacing them saying, oh, it's faster. It's actually super slow. And some of the solutions are actually not even autonomous. They're operated by a human operator in an office. You don't know that. You're seeing these cool videos of robots moving around, but it's actually being operated by a human right now. But what Katya was saying is like you're seeing fast advancement. So I saw a couple of the robots in the wheel in a warehouse setting just for the last 5 years. I've seen it every 6 months. And the progress that these companies have made in 2024 alone is just mind blowing. I couldn't believe how much faster it was. For someone looking at it for the first time, you would be, oh my God, that's so slow. It's like watching paint dry. But you're looking at it from my perspective, where it was really moving in a very slow motion pace. And now it's actually picking up bins, moving things around. And it's really used today for material handling. It's doing various tasks. So to me, that's a pretty big advancement in the last 12 months when you look at it from the robots and also looking at how warehouses are built. So it's definitely here to stay. What form factor, I don't know, but the wheels are definitely a plus, not a negative.
Can I ask you, I in the past, I was heavily invested in Japan. I've spent a lot of time investing for a time, maybe even today. They were the most advanced producers of robotic equipment, but they're not the most creative people when it comes to new tech. So have you had interaction exposure with existing robotics and the advancements or lack thereof?
Yes, we've been tracking the robotic industry from industrial manufacturing side of the autos to today, what we're seeing. And it's fascinating. In terms of market share, Japan is still leading in the robotic space. In terms of sophistication and capability, it's really US. So it's really the research, R&D, and also the venture backing that's really caused that. Japan is trying to still navigate. You're seeing Korean makers coming out, but they are more comfortable building for the auto industry and not really for other industries like the warehouse or distribution centers or other type of manufacturing. So you're still seeing that US is really building a better solution that has AI embedded solutions, various different types of sensor technologies, lots of really strong software in the US. So in terms of the robotic race, it really depends on, is it the industrial robotic or is it smaller form factor? Are you measuring it by performance, creativity, capability? We're seeing a US is really outshining everybody else right now.
My only other comment is the reason why we call it a deep tech panel is because there's no way to achieve space and things like that without robots and AI enabled robots, right? I mean,
this is also reference to something that Andrew, you had said earlier, about AI being differentiating between AI as a tool and a solution. And also that machine learning and real neural networks are really the real AI that exists right now. My question is, when it comes to like things like generative learning, companies that are using like their legacy products and propping them up using AI, how do you differentiate like true AI companies versus those companies just leveraging it as a tool for their legacy products?
Well, on the first camp, those existing companies, their productivity is measurable because they produce things. What she was just talking about, they all produce things, they do things, it's measurable. So one of the great advances in automation is a place you'd never see it, and they're using AI, is in chip production. So chip production, although it's gone on this path for years, there were a lot of error rates and waste. The latest, greatest chips are produced with very little waste and very little error because of some of the technologies she was just talking about. And originally, the Japanese were the ones making the logistics technology for semiconductor production years ago, and they were surpassed by America.
I think, I get your question because when we first launched our AI strategy, we did the same thing. We wanted to invest in enablers and developers of AI. We thought they would get premium valuation and versus companies that were just leveraging AI to just enhance what they currently have or improve their margins. For us, we thought we weren't going to discriminate if we were going to have a balanced approach. The companies are leveraging AI, though, it has to be meaningfully getting massive revenue opportunities. It would have to be a meaningful impact, and that's how you're leveraging it. Or without AI, maybe your business will cease to exist. So that's how we sort of kind of qualify that. And then obviously the enablers and developers right now, what you're seeing with all the build and venture backing of AI companies, the infrastructure companies are really leading right now. But that's because right now it has to be built. That foundation is getting built right now. So you're not seeing a lot of the application companies. But I think in the future, we're going to have most companies going to be leveraging AI, and it's going to be hard to distinguish.
Can I comment on the word meaningful? So the way I would look at it, nothing about it, or just take that idea. And so there's a lot of things all of us in this room can use to increase productivity using AI. I do it. Computer programmers actually are writing programs faster using it, but that's not a company that's changing its business. Meaningful is identifiable in an existing company because they have a plan, they have a budget. This stuff isn't cheap, by the way. You don't build data sets, train AIs, and implement them for $5. It's expensive. And there's been big expensive failures. Out of OpenAI was Inflective AI, 1.8 billion in chips, and it was a bad business model. So those companies that are doing it, you should see it. They should have an effort and a plan to get data they probably had sitting somewhere, they didn't even realize it, organize it in a way, have people that are training models, because models don't appear out of the sky. They have to be trained and trained and trained and overtrained again. And you'll see it. And the ones that are being left behind, you're going to ask them, they're going to know what are you talking about. We were businesses.
Lisa brought up an interesting comment about the robotics. We're saying that the U.S. was stronger for robotics, for a culture of innovation. I think I saw comments from Palantir's CEO the other day where he was talking about that more generally for technology, saying that the U.S. just had overwhelming, was overwhelmingly ahead of other countries around the world because of our culture of innovation here, as well as regulatory factors and other cultural factors. Do you subscribe to that?
Yes, definitely. I think there's two distinguished, like robotics and then AI. And AI, definitely, we are dominant force in terms of innovation. A lot of it has to do with the innovative mindset, R&D, and also the venture community. The venture community in the U.S. is very vibrant, strong, very forward-thinking versus the other countries. So you're definitely seeing that. Robotics, in terms of people think about market share, or let's say the manufacturing is in China is the biggest in the robotic industry. Japan and Germany are the biggest in terms of market share. But the creativity and innovation is really improving in the US, and that's where we're winning. And I think that this should continue as long as we have the government backing for some science and technology R&D spending that should increase over time. I know it's a very complicated issue, but if US do want to care about this and want to continue to leading the race, we can't cut spending on the R&D efforts.
Can I just make one comment, just getting back to some of the stuff that Katya was saying, which is that from all this investment, stuff just falls out that you wouldn't imagine, like Starlink and the military usages of it during the Ukraine war and things like that. Or, I mean, it's just very powerful, but it only becomes obvious after the fact.
Actually, step further, all that semiconductor technology he's talking about came out of military research that didn't work in the military, by the way. I wish Peter Thurlow should be on this panel. He's our host, not in this room, connected to DARPA. And a lot of stuff coming through my inbox these days is dual use military technology, and dual use being the operative word about falling out. So you're talking about advanced materials, you're talking about advanced processes, sensors, all that type of stuff that the military wants. They're sourcing it from, not from military contractors. They're sourcing it from the investments that everyone else is making in other things. So I even met a woman from Lockheed Martin Ventures, who was the only person I knew in DPV lithography was, because they pulled her out of the engineering department. She had not been in investing before. So, and Peter could speak to this really well. So that's a lot of, when you talk about falling out, those are things that are being invented in one place that are now being applied in another. And yes, I think that's happening all over. I'm sure you can see it.
Yeah, definitely. So we're seeing a lot of great US companies that's using off-the-shelf robots from Japan, and then using the creativity of the software to enable to do what the tasks that it's been created for various industries. I think one of the questions you also asked was the M&A environment. Our M&A environment, obviously the last few years was very difficult because of regulation. And we do hope that, without making any predictions, we do hope that the M&A environment should actually pick up.
Just on a comment of exits, I want to go back to the whole thing, but I have never invested in a company that was successful that never had an exit. You should worry about your companies being successful. And she was joking before about 40. I'm way older than she. That company should be successful for your grandchildren. So when we're co-investors and in technology, we want to see any technology we invest in able to be in the marketplace or fail within 5 years. It doesn't, it's not the exit of the investment. It is the success of the investment as measured in the marketplace. And once they're in the marketplace, there's all kinds of options. And as I pointed out, we had strategic investors come in, never had venture capitalists follow up.
I should have asked this earlier. What are the approximate sizes of the
Get some
investments?
comments from Katya?
Sorry, yeah, I just wanted to jump in for a second. So besides AeroCore, we have 300 companies in our portfolio. We've invested in quantum computing companies. Some of them are some of the most successful ones, like IonQ. We've built major deep tech companies. Our largest one is Acronis. It's a global cybersecurity firm. It has about $3.5 billion valuation right now. So a lot of things that I would say to look at right now when we're investing, like taking my company aside, but the deals that we're looking at and looking at the tech and really understanding it, again, is really understanding the IP, right? And what there is actually significant and what's there and what's really actually proprietary and has value. What is really there at a base layer, taking into consideration, as I was mentioning before, how fast this industry is moving. You know, certain things that are a big deal now might be totally obsolete very soon. So you really have to have this very, very strong focus and understanding. And the biggest thing on deep tech, to be honest with you, is we look at very long lead times. You know, we're one of the leading investors in quantum. And that's not anything that's gonna, you know, come to fruition anytime too soon. So we look at things that we can really be in the long haul for. And yes, I completely agree with you. You need to look at things that in the next, 3 to 5 years, you're gonna actually see it come to fruition or have some value and all of that, even if you're not expecting a major exit. But I would say that when you're not looking at like regular tech, but you're looking at deep tech, you need to have a very, very strong background in understanding science, or you need to have people who actually can kick the tires and really understand what it is that they're looking at, and also the ability to have a stomach for very long timelines.
Great points. Thank you. I was going to ask, what are the sizes of the investments that you make on average?
It ranges between $250,000 to $3 million. And we think that we're happy to support through various rounds. So we try to save some reserves for follow-on opportunities. We also like when, if a company it seems to not be working out, we would rather they just shut down or sell parts of the business so we could allocate our time and resources to other companies that's gonna get ahead. And in this industry, because it's so emerging, it's okay. It's okay to see these companies shut down. We could maybe buy the IP for someone else, some of the talented people should go to another robotic company. So we really do believe that it's pretty natural for emerging market companies to really, at some point, if you can't scale, if you can't find the product market fit, to be able to just move on rather than dragging the investors' time and keep on trying to survive. Because maybe they're just too early and they'll have to pivot and come back a different way. There's a shortage of talented, skilled workers in some areas. So I would love to see some of these companies consolidate. I would love to see companies be able to acquire in a better regulatory environment. So those are some things that just didn't happen the last few years. And I think that's very natural in the technology market to have that type of cycles.
Lisa, is there a marriage of the DARPAs of the world and EQTELs with your industries?
Definitely. One of our advisors is actually part of DARPA. We have a very strong affiliation with universities. We have 6 different universities where we work very actively. We get to see what's happening in the research setting, what the students are working on, what's not working. And we really learned a lot about foundational models before people started talking about it. So we've been looking at all these foundational model robotic systems.
Capital deals usually fail. If you track right here, too, of the ones that have failed, why did you miss? That jurisdiction to avoid the high rate of fail.
We're still an early fund with a young vintage, so we haven't had a lot of companies fail. But I do agree with you that probably in the normal markets, 80%. Very many companies stretched their dollars a little bit the last few years. So some of them should have failed, but they just cut costs. So it's really hard to tell. We had one company that didn't work out. And for them, it was actually very surprising. It wasn't the product or customers. They actually had more orders than they could fill. It was really the funding environment. One of their investors sort of had second thoughts at the last minute. And many investors could step in and say, you know what, we could help you and just fill this gap. All of us decided to let this company just shut down and liquidate. But it's not a normal bankruptcy situations anymore. You're seeing lots of creativity. You're seeing parts of business getting sold. So I don't really see it as a failure or shutdown. It's more of just taking half the company to another company and then just pivoting. But in terms of investor perspective, I guess that was not a good outcome.
But I would agree that you should cut your losses. The companies that don't keep putting money in the companies, there's a disease in venture capital that we've done the B round, the C round, and they're going to keep supporting them forever. And that's been the problem. And the problem of size has been the grow big fast model. We're going to take this thing, we're going to throw so much money at it, it's going to conquer the universe. So those are huge failures. Instead of having companies that, oh, this isn't working, let's just cut it. And then, so your 8 out of 10 could be right, but the dollars gained versus lost is highly distorted. You know, in hedge funds, we see a 51% profitable trades, hugely profitable fund because their losses are this big and their gains are that big. So the other side of funding and size is that you would be shocked, depending on what the opportunity set is, that you're putting in small dollars and the opportunity set is big and huge dollars can follow. So people say, oh, we need to raise 2 million. Or somebody says, oh, we need to raise 100 million. I'll say, you know what? I can't even tell you which is going to be easier until we see what all the circumstances are. Because there's times where raising 100 million is a lot easier than raising 2. So that's the way to approach it. Avoid the grow big fast. Good advice is cut your losses short. Be creative. If you had a contract or something like that, there's people that finance contracts. They have nothing to do with venture or hedge funds. They're in the business of financing receivables. You can go to them for, so be creative.
Yes, and that's exactly what sort of Katya was saying about the IP. We make sure not only do we like the founders, but look at their IP portfolio to see what is the tangible value if we have to sell, if they have machinery, equipment that's worth something. We do like to invest in follow-ons when we see some early traction of leadership, and then we want to double down at as possible as we're able to do it. The funding environment was so difficult that we're going to wait for next couple years when the environment is a little bit normalized before we come big and aggressive, but we can write bigger checks than 3 million.
This way. There's a reason why companies don't succeed. The reason you invested is the reason you invested was that system. And if it wasn't, why? Was the technology misunderstood? Did the management team have the capability to scale? I go right down.
Stop,
the list.
stop right there.
That's what I was-
Stop right there, because with the DeepTech panel, talking about technology, companies failed more because of bad management than they do because of bad technology. So the fact that they want to retain IP is a defense mechanism against that. And so you're investing in the people just as much as you're investing in the technology. And so your failure rate that's high comes from also investing in the people. And so that's a hard thing to do, is to be evaluating the technology in parallel with the people. I've made the mistake of spending a year on liquid chromatography in the pharmaceutical industry, then realizing I couldn't invest in management. So you have to kind of do them in parallel. And things fail more because of management than they do because of tech. If you do your homework.
Yeah, I agree with that. And I think it's also when you're in a difficult environment and you're not navigating, they're also learning too. So hopefully some of these founders that failed learn from this, and then maybe the next time they try, they'll take some of the learnings with them, because I don't really like to say that every founder, if you fail first time, you can succeed again. Some of the most successful founders have failed
The
many
opposite.
times.
There was some study that the biggest venture successes, the founder failed. This is their third try.
Lisa, who were the acquirers in your space?
We have a very heavy tilt towards industrial automation. So natural acquirers for our companies are Rockwell, Siemens, Toyota, and larger, and companies like Zebra were very big in supply chain management. And they, by the way, been super quiet the last few years, even though they do have some cash in their balance sheet. I think the macroeconomic environment and the election sort of held off on doing any major acquisitions. So it'll be interesting to see what next year is going to be like.
So we live in this interesting time where venture capital, you can be too early. And we have a guy who started an AI hedge fund of funds, who's been a speaker at our events for 15 years, Michael Weinberg. He started in 2017. Did not do well as a hedge fund, right? But at the same time, if in venture, if you're in a space for a very long time, you become known as the person who has been doing it, and therefore you will become the magnet for all those deals in the future. You know, like Ron Conway's group has spoken at our events many times, and the reason why they got the Google deal is because they had been part of the Yahoo deal, and Google initially wanted to sell itself to Yahoo. Right. So I mean, that happens in venture.
Well, the hedge fund lesson can be applied to a lot of things. Is that the problem with the traditional hedge fund is that they're looking at historical data sets that are fixed. They can play games with them, but trust me, those data sets have been run over by algorithms 400,000 times. Okay. So if you're going to, and I ran a very successful fund of hedge funds for 15 years. So, and a third of our strategies were all quantitative, systematically driven. So no one's alien to that. In fact, the opposite. These people have put more physicists, time, effort, and money into AI than we're even talking about here, because they won't sit up here and talk about it. Because I know. You think James Simons at Renaissance didn't try AI, 10 years ago? And ever since then, of course he has. The problem is that's historical data. So what's actually is changing, for instance, in stock picking, well, that's historical data, fundamentals, it's all public stuff. Metadata, being able to look at entire cellular network and see where the traffic is and when it comes and goes. Now, people have been trying this, but by hand, you can't look at much. But with AI, you can look at a lot of data, because it doesn't have to be perfect. It just has to narrow things down for you. So if you're looking at retailers and traffic and stores, you look at cell phone traffic in their parking lots and things like that. That's metadata. That's not historical market-driven data. And my first boss as a prop trader said, when I got out of college, I was an econ major that could code. He goes, and this isn't physics. Every piece of data is made by some human being making a decision to buy or sell something. The sun will come up tomorrow, that's physics. That data is not physical data. It's data that's created by human beings and with all their false issues.
So that type of locational data is definitely in use in real estate world, and retail world for site selection and other things, investment selection, housing, all kinds of things.
So that's metadata, and a real estate investor now can look at all the zoning and all of the local schools and the data all in one shot, as opposed to having to write algorithms to figure.
Yeah, and there are companies that have been built up, prop tech type companies to service that.
Absolutely. And then that's the tools area of investing in AI, whereas the real estate people are in the solution business. So they're both.
Marty had wanted to talk about space. Is space the final frontier, or is anybody investing in things related to
talked about
space?
Dual military use, and my first thing I say is, you want to invest in SpaceX, first remember, SpaceX has 5,000 subcontractors, 5,000. So every rocket that goes up is 5,000 companies that did something to make that rocket go up. So I don't know what Elon Musk, if he wants to go to Mars and spend all the money, I don't know. Whether they just stop and launch Falcon 9s and make a ton of money, I don't know. All I know is all of that activity is being driven by thousands of companies that have to make the components to make it happen. And their business is based on the volume of things that go up, not whether we get to Mars or not.
Right. You can say that about almost any business.
Not true.
I mean-
That is not true. No, I have to disagree with you.
Okay.
That's not true. First of all, the high-tech space.
I don't mean in a critical
No,
kind of way, but
No, I'm just saying is that the space business, first of all, nothing ever happened in space without government spending money. There is no profitable way to just get to space and just do it. Otherwise, it would have happened a long time ago. It's all following on government subsidy, government money. So, but the simple fact is the complexity of it. So take Lockheed Martin instead of SpaceX. Lockheed Martin never makes a lot of money. The reason they never make a lot of money is they're always investing in the next best military tech. They spend as much money, and as does Boeing and everybody else, as they can possibly make. On the other hand, there's thousands and thousands of subcontractors in materials, in sensors, in computers, in whatever systems that go into all of that stuff. So I think a successful investor looks at that whole ecosystem, not just the headline company that you see going to space or whatever Jeff Bezos is. Jeff Bezos has to pay for all that stuff somewhere. I don't have to invest in Jeff. I can invest in the companies that are making his rockets.
So at that point, you look at the single purpose investment opportunity. Everything else is reliant on.
Well, do you think company that makes sensors? No, well, it's not even dual.
That failed, everything else failed.
No, because the company that makes sensors, and she could speak to this, is that they make sensors for maybe 100 different things, not just dual use. Can you comment?
Yes, I mean, I think this is a very long topic of
Well,
whether space tech is an industry as itself, but for us, we are interested in space. We don't have a ton of expertise at the moment. We have one advisor who actually comes from Incotel, and he does have that defense tech industry background, and we did one investments together, mostly in the AI software for the space industry, but they also have multi-industry use case working with insurance companies, for example. So that's an area where we would look at. I think that right now we look at companies, even in the shipping railroads. When I see the innovation that needs to occur here on land, it's hard for me to even have any resources and time to think about space. That would be a separate new fund. But there's the sophistication and innovation around the sensing technology is really continuing. A lot of the actuators that have to be created for the space industry, they're pretty similar to the ones from the other manufacturing auto industry. I do think there's going to be a whole new set of investments of infrastructure that has to be built for space. And I think there are other better space tech funds to capture that.
Okay,
Also, the use of space, again, so by the way, I tried to buy the Iridium bankruptcy in 2002. I don't even want to tell you what it went for. The .com plus had happened and our venture fund, our reserves were down. $25 million for 85 satellites. Still in business, by the way, until Starlink came along, was the only game in town. So you have all these telecom companies, all these businesses that are using space to do their business rather than space being the business. And I would also be looking at that.
okay. Katya, anything you'd like to, Katya still with us? God. Okay, great. Anybody else have any questions for our panel? Dan, something you want to ask? No? Okay, I guess we're done then.
Fantastic. Great
Thank
job,
you.
guys.
Thank you.